All right, let's dive into a question that I know is on a lot of people's minds. With so much going on in the world, why does the stock market just seem to keep climbing higher and higher? Let's get into it.
I mean, you're not crazy for thinking this, right? You look around, you see some economic uncertainty, maybe things feel a little shaky, and yet the market seems to be living in a totally different universe. It can feel completely disconnected from our day-to-day reality. So in this explainer, we're going to peel back the layers and look at the powerful forces that are actually inflating this market. Okay, so where does this all begin? Well, the story really starts with one of the most powerful forces in all of finance, the engine of cheap money. This is the fuel that gets the whole thing running. So it really all boils down to the US Federal Reserve, or the Fed, and they've got two main tricks up their sleeve. First, they lower interest rates, which makes it way cheaper for companies and people to borrow money. And second, they do something called quantitative easing, which, yeah, is a fancy term, but it basically just means they're pumping cash directly into the financial system. The result? A giant flood of new money that's suddenly looking for a place to go. And here's the thing, right? This massive amount of cash, it doesn't just sit in a bank account earning next to nothing. It has to go somewhere. So investors, everyone from huge hedge funds down to individuals, they all start hunting for a place where that money can actually grow. And that's where stocks just become the only game in town. There's actually an acronym for this effect you hear a lot, TINA. It stands for There Is No Alternative. And it makes sense. When so-called safe assets like bonds are paying out almost zero, the potential for high growth you can get in stocks looks incredibly tempting. It just pulls in a massive amount of that newly created cash. Okay, so we've got the fuel, which is all this cheap money, but what happens when you pour gasoline on that fire? Well, that's where things like leverage and buybacks come in. They're like powerful accelerants that just make the fire burn hotter and faster. All right, first up, let's talk about something called buying on margin. Now, this is a really common practice, but it's also a very risky one. Put simply, it just means you're borrowing money from your broker so you can buy even more stocks. So, let's break it down. Imagine you've got 10 grand in cash. Your broker might let you borrow another 10 grand, which means you can now invest a total of $20,000. Now, if the stock goes up, your gains are based on that whole $20,000 pot, essentially doubling your potential profit. Pretty great, right? But, and this is a huge but, leverage is a classic double-edged sword. Because if that $20,000 investment drops, your losses are also magnified. A 20% drop means you lose $4,000, which is a whopping 40% of your own money. When the market turns sour, this can trigger massive forced selling, which is how crashes can accelerate so quickly. All right, the second accelerant is something that companies do themselves. It's called a stock buyback, and it is exactly what it sounds like. A company uses its own cash to buy its own stock right off the open market. And these buybacks are, well, they're kind of genius in how they work. They have this powerful, multi-pronged effect. By taking shares off the market, they make each remaining share look more profitable. That's the earnings per share, or EPS number, that investors love to see. It also creates constant demand for the stock, which helps prop up the price. Now, the big criticism here is that this diverts cash that could have been spent on things like research and development, for actual long-term growth. Okay, so let's pull back the camera a bit, because this isn't just happening inside the US. The American stock market has become this unbelievably powerful magnet for money from all over the planet. And you can totally see the appeal, right? If you're an investor sitting somewhere else in the world, the US market offers this unique mix of strong historical performance, stability, and liquidity, which just means it's super easy to get your money in and out. Plus, let's be honest, if you want a piece of the big tech giants, this is the place you have to be. A classic example of this in action is something called the yen carry trade. For years, interest rates in Japan have been practically zero. So what do investors do? They borrow Japanese yen for next to nothing, they swap it for US dollars, and they pour it into US stocks hoping for a much higher return. It's just one of many ways that global cash finds its way here, pushing prices up. So you take all these ingredients we've talked about, the cheap money, the leverage, the buybacks, the global cash, and you mix them all together. What do you get? You get this incredibly powerful, self-reinforcing feedback loop. So it kicks off with that first spark. The central banks turn on the money hose, creating this environment of easy, cheap cash. So what happens next? Predictably, that money goes hunting for a return, and a lot of it floods into the stock market. You have more buyers than sellers, so prices, well, they only have one way to go, and that's up. And this is where basic human psychology kicks in. Big time. People see prices going up, and they get a massive case of FOMO, the fear of missing out. They start jumping in because they're terrified of being the one left behind. That feeling, that FOMO, it's like a magnet. It pulls in a tidal wave of new money from both here and abroad. And it gets amplified by things like passive ETFs, which just automatically buy more stocks as money flows in, often without even looking at a company's real value. And of course, what does all that new buying do? It pushes prices even higher, which just proves to everyone they made the right choice, attracting even more investors. And you can see how the cycle just keeps feeding on its own momentum. So this all leads us to the big, unavoidable question. What are the actual consequences of a market that's running on liquidity and momentum like this? I mean, what happens when prices get this detached from the fundamentals? Well, the implications are pretty serious, and we don't even have to guess, really. History has shown us, with the dot-com crash or 2008, that when the confidence in these inflated markets finally breaks, the corrections can be sudden and really, really sharp. All that leverage we talked about makes the losses even bigger, and you risk a spillover into the real economy. It puts policymakers in a really tough spot. It really does become this perfect, self-fulfilling prophecy. As the quote says, investors buy because they expect prices to rise, which makes prices rise, attracting more buyers. That is the textbook definition of an asset bubble, driven by nothing more than expectation. So there you have it. You've got cheap money, leverage, global capital, and pure human psychology all working together to build this absolutely massive bull market. But that leaves us with one final and maybe the most important question of all. What happens when these powerful forces eventually go into reverse?